how did the decisions made by, the most powerful economic players on the planet directly shape your financial future? Today, we're embarking on a deep dive into precisely that, focusing on one institution in particular, the Federal Reserve. We're going to explore some truly intriguing possibilities regarding shifts in Fed policy, especially under a potential new administration. This isn't just about abstract economic theory, it's about how a future Fed chair might tackle the national debt and interest rates in ways that could, well, fundamentally redefine our understanding of money itself. It leads us straight into the principles of modern monetary theory.
Yeah, exactly. And our insights today, they come from a pretty detailed analysis presented by financial experts who have been closely examining the stated goals of a potential incoming administration. They've also kind of pulled back the curtain on some surprisingly unique accounting mechanisms the Fed itself uses. It's a perspective that really offers a significant shortcut, I think, to being well-informed on what could be one of those impactful economic shifts of our time.
Absolutely. Our mission for you, our listener, is to connect these seemingly separate dots into a clear picture. We're going to break down how these complex ideas converge, giving you a comprehensive understanding of a potential major economic transformation. We'll navigate this journey in, let's say, 3 distinct steps. First, we'll examine the administration's core objectives for the Fed. Second, we'll uncover a very peculiar accounting practice the Fed employs, sometimes called a magic trick. And finally, we'll reveal how all these pieces could align with the, well, controversial framework known as modern monetary theory. So let's dive in. Okay, so at the heart of our discussion today is this idea that a new administration might seek much greater control over the Federal Reserve and, by extension, over interest rates. We've heard quite a bit of public discourse around figures like former President Donald Trump and his expressed interest in, influencing the Fed's direction. It's a significant departure, really, from the traditional notion of an independent central bank.
Right, really is. And what's truly fascinating here is the strategy proposed to achieve this influence. It's not just about a straightforward replacement of the current Fed chair when their term expires. The analysis suggests the more proactive approach, influencing Fed policy by selecting what some are calling a shadow Fed chair, much sooner than you might expect. This would be someone, highly loyal, deeply aligned with the administration's goals, maybe someone like a Scott Bassett. The idea is that such an individual could potentially be brought into a key position by, say, May 2026. And their influence would start to be felt long before any official change at the very top. Markets, economic players, they'd start paying close attention to this potential future leader. It effectively prepositions the Fed for the new administration's agenda.
Interesting. And the driving forces behind this push seem quite clear. There are 2 primary objectives, right, for this potential new Fed chair. The first is a strong desire to significantly lower interest rates.
Yeah, that's number one.
The belief is that lower rates, maybe even aiming for something like 1.75% when the European Central Bank might be at 2%, could really ignite economic growth and give the U.S. a crucial competitive edge globally. It's not just general growth, right? It's about making borrowing cheaper, spurring investment, maybe boosting asset markets too.
Precisely. And that leads directly to the second, equally critical objective, radically reducing the burden of interest payments on the colossal national debt.
Mm-hmm.
The current trajectory of U.S. debt is widely viewed as unsustainable. I mean, that word keeps coming up.
It does.
To put that into perspective, if we look at the U.S. debt to GDP ratio, that's a key indicator of a country's ability to pay off its debt.
Mm.
It was around 60% back in 2000, relatively modest. After the global financial crisis in 2008, it shot up dramatically, surpassing 100%. Then, following what's been called the survey sickness, the term used for the economic disruptions and massive government spending from the pandemic, it went basically parabolic, hitting around 130%. It's come down a tiny bit from the peak, but now it's ticking back up again. Yeah. And as Lynn Alden, a highly respected financial analyst, puts it very succinctly, nothing stops this train.
Ah.
Which isn't, meant to be cynical, but it's a stark observation about the underlying structural factors, spending patterns, entitlements, this persistent fiscal imbalance. These seem to ensure continued increases in both debt and deficits. Now, think about the consequences if this just keeps going without a solution. If demand for U.S. Treasuries, our government's IOUs, basically starts to decline while the supply keeps increasing because of these growing deficits, what happens? Well, basic economics tells us prices for those treasuries will fall, and conversely, their interest rates will skyrocket.
Which makes the debt payments even worse.
Exactly. Even more untenable. So this is precisely this scenario the administration aims to avoid with lower rates and potentially a whole new approach.
Okay, that paints a pretty clear picture of the fiscal challenge we're facing. So with those goals in mind, let's pivot to something truly surprising, almost counterintuitive about the Fed itself. It has this unique accounting mechanism that, to an outsider, looks like something out of a financial wizard's spell book. It's officially called a deferred asset.
Right. This is where things get genuinely fascinating, and it really highlights just how different a central bank is from, well, any other entity. Let's try an analogy to make it clear. Imagine your personal bank account is in the red. You spent more than you've earned, negative balance. In the real world, that means you're in debt, right? You owe money. If it gets bad enough, you might even be declared bankrupt.
Sure.
But what if, instead of being truly in debt, you could legally write yourself an IOU, a promise that you will earn enough money in the future to cover all those past losses? And then, kind of bizarrely, put that IOU on your balance sheet today as if it were a real, tangible asset. You'd technically appear perfectly balanced on paper, even though you don't actually have the cash to cover those losses right now.
Okay, so if I'm following this, when the Fed's expenses actually exceed its income, which started happening, you said, around late 2022, they don't just report negative capital like a regular bank would. They don't say, oops, we're insolvent.
Exactly right. Instead of showing losses that would dip their capital below zero, they record this cumulative amount of future earnings they expect as an asset today. Think of it as an accounting placeholder, a sort of negative liability that cancels out the loss. It allows their assets and liabilities to always appear to match, neatly sidestepping any official declaration of being insolvent. Now, it's a non-cash accounting item. It's not real money they can spend. And here's the crucial point, the really extraordinary part. This mechanism is absolutely unique to central banks. For any commercial bank, any private corporation, doing something like this would be, well, illegal. It violates standard accounting rules, regulations. It would likely lead to immediate intervention from regulators. So this deferred asset fundamentally redefines what solvency even means for the Federal Reserve.
It's truly an extraordinary accounting mechanism, isn't it? It just underscores how uniquely powerful the Fed is. Operating under a completely different set of rules than, well, pretty much any other financial institution, they can effectively sustain losses that would absolutely collapse a commercial bank just by promising themselves future earnings. Okay, so we've laid out the administration's clear goals: lower interest rates, making the national debt sustainable. We've also pulled back the curtain on the Fed's peculiar deferred asset accounting. Now, the big question: how do these two seemingly disparate pieces converge? And what does it all mean in the context of modern monetary theory, or MMT?
Right. This is where all the threads really weave together into a truly remarkable tapestry. At its core, modern monetary theory, or MMT, posits that a government that issues its own currency like the United States doesn't technically need to tax its citizens or borrow money by issuing debt to pay its bills. Instead, it can simply increase electronic digits in bank accounts to fund its spending. Just create the money. The only true limit to this, according to MMT proponents, is inflation. If you create too much money without a corresponding increase in real goods and services available in the economy, then you start to see prices rise, which can obviously be detrimental.
And how does that fundamental MMT premise contrast with how the U.S. government operates right now? How does the Treasury typically fund its spending today?
Well, currently, if the Treasury wants to pay someone in the real economy, let's use your example, Alex Smith receiving a Social Security check, or maybe a government contractor getting paid, the Treasury basically has two ways to get that money. It must either collect taxes from people and businesses, or it has to borrow money by issuing debt, meaning selling U.S. Treasuries to investors. That's the traditional way.
Right. Tax or borrow.
Yeah. Exactly.
Yeah.
But the Federal Reserve operates on a different plane entirely. When the Fed wants to pay a commercial bank, for instance, it doesn't need to tax or borrow. It simply creates more bank reserves. These are essentially just electronic balances held by commercial banks at the Fed. And crucially, this doesn't increase the national debt because no Treasury bond is issued. It's just an accounting adjustment within the central banking system itself.
Got it.
Now think about this. The Fed's ability to just add electronic digits to bank accounts without needing to tax or borrow, particularly when they can use this deferred asset mechanism to cover any deficits generated on their own books. It's kind of like having a master key to the national vault.
A master key. Okay, I like that metaphor.
Yeah, traditionally, to put funds into that vault for the government to use, you need to collect taxes or borrow money by selling bonds, right? Those are the normal keys. But with this master key, the Fed can just click, unlock it, and fill it whenever needed. As long as adding too much money doesn't make everything else inside the vault, and indeed the whole economy, lose its value because of inflation. It bypasses the traditional constraints of revenue generation.
That master key metaphor really does underscore the immense power the Fed wields there.
Mm.
So, bringing it all back together, how does this inherent capability of the Fed combine with an administration's desire for a loyal Fed chair and these specific financial goals? How does that potentially lead us to MMT being put into practice, maybe even without explicitly saying so?
Okay, here's the truly radical implication. If a yes man, Fed chair, someone totally aligned with the Treasury's objectives and the administration's desire for lower rates and debt sustainability were in place, they could effectively bypass the Treasury's traditional need to tax or borrow. Imagine a scenario, maybe a bit futuristic, where various entities in the economy, whether it's Alex Smith getting Social Security, a defense contractor paid for a huge project, maybe even states getting federal aid, could hold their accounts directly at the Federal Reserve, not just through commercial banks or the Treasury's main account. Directly at the Fed. Okay, directly at the Fed. In that kind of hypothetical future, the Fed, now steered by someone loyal to the administration, could simply make those payments directly by creating new electronic reserves in those Fed-held accounts. And if this spending caused the Fed itself to incur losses on its own balance sheet, well, that's where the deferred asset trick comes back in. It would simply be used to cover these expenditures on the Fed's books, meaning no new national debt in the form of Treasury bonds would need to be created. The unsustainable debt problem, at least in principle, just sort of vanishes because the government is funding itself without issuing new debt to the public.
Wow.
It's a direct application of MMT principles, where government spending is limited only by its inflationary impact, not by the need to tax or borrow first.
So it's not necessarily about the Treasury Secretary and the Fed chair literally becoming the same person or merging their balance sheets entirely. It's more about a profound alignment of policy objectives that enables this kind of mechanism.
Exactly. That's the key. The critical factor is that future appointees, loyal to the administration's vision, would pursue these same policy goals. Aggressively lower interest rates for economic activity and find creative ways to make the national debt sustainable. And this could involve these unique accounting gimmicks and implicitly or even explicitly adopting MMT-like strategies, all without ever needing to declare, okay, folks, we are now operating under MMT.
Right.
The institutional independence of the Fed, as we've traditionally understood it, would be dramatically reshaped in that scenario.
Wow. That truly connects the dots from high-level political intentions and the very pressing issue of national debt, all the way down to obscure central bank accounting practices. And it all leads to a potential paradigm shift in how we fundamentally think about government spending, national debt, and the very nature of money creation. It paints a picture of a future where the traditional constraints on government finance might simply, well, no longer apply.
Indeed, it's definitely a lot to consider. And, given these potential shifts and the unique powers of a central bank, it really makes you wonder, how might these unconventional monetary strategies redefine our understanding of national debt and economic stability in the years ahead? What might be the true costs and benefits, the risks and opportunities of such a significant departure from traditional fiscal and monetary policy? These are precisely the kind of profound questions we aim to unearth here in the deep dives, really helping you navigate the complex currents shaping our financial world.
Absolutely. And if exploring these potential shifts in monetary policy has broadened your understanding and maybe left you with some powerful new insights, we definitely encourage you to follow, like, and share this deep dive. And for even more insights and analysis on the intersection of finance, economics, and technology, make sure to follow What Bitcoin Taught Me. You can find us on Twitter, X, Nostr, Bluesky, Threads, Instagram, Facebook, and LinkedIn.